The news says the stock market just lost $11 trillion. Okay, so where did it go? Like, somebody got it, right? $11 trillion doesn't just evaporate. Some villain in a suit is sitting on it. Here's the part that breaks people's brains. Nobody got it. It didn't go to the rich. It didn't go to China. It didn't go anywhere. Most of that money was never a pile of cash to begin with. It was a price tag, and the tag just dropped. Stick with me, because once you see how this actually works, you'll never panic sell again, and you'll spot who genuinely does pocket real cash when everyone else is losing it. Let's get into it. Everybody pictures the stock market like a giant vault. You imagine your money is in there, sitting in a pile, and on a crash day someone backs a truck up and drives it away. That mental picture feels obvious. It's also completely wrong, and it's why crashes feel so terrifying and unfair. Like you got robbed by someone you can't even see. So when your portfolio drops $5,000 in an afternoon, your gut screams, "Someone took my $5,000. But there is no truck. There is no vault. The $5,000 didn't get moved, and what actually happened is weirder and honestly kind of freeing once it clicks. To get it, we have to answer one dumb-sounding question. When a stock is worth $100, worth $100 to who? This isn't me being edgy, it's just how markets are built. The repricing idea is Eugene Fama's efficient markets work, the panic overshoot side is Robert Shiller's irrational exuberance, and the why a crash still wrecks the real economy part is a Case, Quigley, and Shiller study. Real economists, real journals. Two ideas unlock the whole thing. Here's the first. Here's the secret the vault picture hides. A stock's price is just the last price one person paid for one share. That's it. If the last person to buy one share of a company paid $100, then every share is suddenly worth $100 on paper. Multiply that price by all the shares that exist, and you get the company's market cap, the big scary number on the news. But notice what just happened. A single trade between two people set the value of millions of shares that nobody traded. So that value isn't a pile of cash sitting somewhere. It's an estimate, a sticker price the whole market agrees to pretend is true until the next trade. Economists call it mark-to-market. We mark everything to the most recent price. Which means the instant someone sells one share for less, every share restamps lower, and trillions in value can blink away without a single dollar changing hands. Money didn't move. The sticker changed. Let's kill the villain theory for good. Say a stock falls from $100 to $60. The news yells, "Value destroyed." Your gut yells, "Someone took the $40. Nope. The $40 didn't transfer to a buyer, a bank, or a billionaire. It just isn't. The price everyone agreed to pretend was true got re-agreed lower. Paper wealth doesn't relocate when it falls, it deletes. Think of your house. If the home next door sells for way less, your house is suddenly worth less too. Even though you didn't sell, didn't lose $1 of cash, and nobody pocketed your lost value. Same exact trick. The loss is real on paper, but it's not a transfer. It's an erasure. Which leads to the obvious objection. Okay, but somebody out there makes money in a crash, right? Yes. And it's not who you think. Here's the honest catch, because it's not all imaginary. Some real cash genuinely changes hands. Group 1, whoever sold early. If you bought at $100 and someone else sold you that share after buying it at $40, they walked away with real cash, your cash, before the drop. The money that disappeared for you was very real for them. It just happened at a different time, not in some villainous transfer at the bottom. Group 2, short sellers. These are people who literally bet the price would fall, and when it does, they pocket actual money. That's a genuine transfer. Their gain is somebody's loss. But, and this is the point, those real winners are a sliver. When the headline screams, 11 trillion gone, only a tiny fraction moved into anyone's pocket. The overwhelming majority erased, not relocated. So the cartoon, a single bad guy hauling away everyone's money, is just wrong. There's no truck. There's a sticker and a handful of people who sold before it changed. Now the fair pushback. If no cash actually moved, Why do crashes cause real pain? Layoffs, recessions, my uncle losing his job? Because feeling poorer changes how everyone behaves. Economists call it the wealth effect. Case, Quigley, and Schiller studied exactly this. When your assets look smaller, you spend less even if you didn't sell a thing. You skip the vacation, delay the car, eat in. Multiply that across millions of nervous people and businesses sell less, so they hire less, so those workers spend less, and a drop in paper wealth turns into a very real drop in jobs. So here's the mind bender. The lost market cap was never a pile of cash. But the fear it creates spends like one. The erasure is on paper. The recession it can trigger is concrete. Both things are true at once. And that's the part the "it's all fake money" crowd gets wrong too. So here's the only part that should change what you do. A market drop is, for you, a paper loss. It becomes a real, permanent loss the instant you sell. That's the whole trap. Panic selling at the bottom is you, personally, volunteering to be the early seller's mirror image, locking in the erasure and handing the recovery to whoever buys from you. And we know this wrecks people. Terence O'Dean found investors cling to losers and dump in fear at the worst times. The disposition effect. And Barber and O'Dean's famous study, literally titled "Trading is Hazardous to Your Wealth," found the most active traders underperformed the market by around 6.5 points a year, mostly by panic trading and overtrading. The market has always restamped higher eventually, even after Black Monday, when the Dow fell almost 23% in a single day. The people wrecked by 1987 weren't the ones who held. They were the ones who sold. So, where does your money go when the market crashes? Mostly nowhere. It was never a vault of cash. It was a price tag, marked to the last trade, and the tag dropped. A sliver goes to early sellers and short sellers, real transfers. The rest is erased, not stolen. And the only person who can turn your paper loss into a permanent one is you, with a panic sell. The one idea: a market loss is a sticker changing, not a truck leaving. It only becomes your loss the day you sell into the fear. So when the next red day comes, and it will, you'll know exactly where the money went, and exactly why the move is to do nothing. If this finally made the market make sense, subscribe. Honest answer.